Tom Lee just issued investors a massive warning saying you should be cautious for the next 8 weeks and that markets are probably going to go into a correction. Take a listen to what Tom Lee just said on CNBC and then we'll break it all down and put it into context for you.
Joining us now with this call for the markets on the first trading day of September is Tom Lee, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. And all along, Tom, when you've made these prescient calls, some of them even short term, it had to do with positive surprises on inflation. And is that going to be enough from here on out to keep the market headed higher, or have we shifted to growth worries now?
I think there's probably more growth worries in people's minds these days. So the jobs reports and claims seem to have more market reaction. I think that's going to be the case in September as well. I mean, we have the Fed meeting at sort of in the middle of the month, but this week is the jobs report. I'm sure there's going to be a lot of focus on that.
Right. So what kept you positive was that the numbers were always, for the market, they were better than people were thinking. Is that going to continue to be the case? But it's no longer inflation, it's now growth. So growth will continue pretty good. Jobs will continue pretty good. You're not worried about another growth scare like we had 6 weeks ago?
Yes, I think that the growth scare is what everyone's worried about, because the July jobs report was kind of a shock to markets, and that's part of how we had that Tokyo Black Monday. I think this jobs report for August is going to show a nice rebound for growth in jobs. Hopefully it's not too strong, because of course, as you know, if it's too strong, people are going to worry the Fed might backpedal on a September cut.
So where does that leave you in terms of what is seasonally, Andrew just alluded to it, September's not great, and we know, I mean, we always make lows in October, or we have many, many times, which means usually a lot of times September was not great.
I think investors should be cautious for the next 8 weeks. You know, September.
Next 8 weeks, be cautious.
Yes.
You're not always cautious.
That's right. When the market's been up 7 of the 8 months this year, so we know it's an incredibly strong market, but we also have the September cuts and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip.
You have, because you're fearless and you'll say anything, you have in the past actually talked about election-related trades and Trump trades. And do you see anything going on now that indicates anything to you? Bitcoin hasn't been acting very well.
Yeah, Bitcoin hasn't acted well. The two things we're watching to sort of look at how election probabilities are weighed is Bitcoin and energy. I think the fact that oil is being weak, even with some geopolitical risks, tells me I think the market is starting to bet more on a Trump election. But
because there'd be more production.
More production.
Bad
yes.
for price, which is not necessarily the way that you might think about things, because we hear about, we're at records for oil production. No one realizes the reason we're at records in this country is because prices were so high that it caused a lot more drilling and activity, and the prices were high because it's harder to drill without and LNG and everything else the Biden administration did.
Yeah, that's right. So people think oil should be higher here for many reasons, but oil's been weak. So I'd say that's probably the market.
That's China too, though, isn't it?
Yeah, China's becoming a bit more mysterious, right? There's even risk maybe of negative GDP there.
Okay, so the next, and funny you said 8 weeks. It's almost exactly 8 weeks, I think. What's that? It's like 63 days or so. So some uncertainty and caution going into the election, but in your view, people should get long.
I think they'll get a chance to buy long, yeah. So I think this is one of those where investors need to be cautious, but in the back of their minds know this is a strong market.
How far down? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. So it's been testing investors' patience. But I think we should expect turbulence.
And then the question, of course, is when the turbulence comes, is it a buy the dip always? Or is there going to be and by the way, buy the dip at when it goes down by 2 or 3%, or you really actually have to wait for a 5, 6, 7% pullback?
I think 1 or 2 is just almost like daily noise. This market has shown pullbacks like that. So I think, I think something like a 5% pullback is very likely, but I think we do.
And are you waiting for that?
Yeah, I think it, you know what, we'll find out this jobs report, because like if it's too strong and investors worry and so the stock market's down Friday, I would be buying that dip, but there's a chance that we get a good jobs report and the market's up. I hate to sound so binary, but I think, I would just say at the bottom line is it's a strong market, so I don't think this is, we've seen the top for 2024. It's just that the next 8 weeks are tougher.
Now, that was very insightful from Mr. Tom Lee, but I'm going to take it a step further. The only thing that matters is this Friday's jobs report. And if this Friday's jobs report is really weak, you could have a 5% negative day on Friday. If the unemployment rate were to rise, let's say, the same as it did the last report, going up 0.2%. If we hit 4.5% unemployment, markets are going to have at least a 4 to 5% down day on Friday. You could actually see a circuit breaker on Friday if we get a really bad jobs report and higher than expected unemployment rate. Like, that is what is on the line here. And I firmly expect that no matter what happens on the positive side for the jobs report, meaning if the jobs report is really good, like 200,000 plus jobs, markets are going to love that. If the unemployment rate falls, markets are going to love that. I don't think that's going to push back on what the Fed wants to do for September. It could push back on some cuts for November and December, but the Fed has basically said either way, no matter what happens at this point, they're going to be cutting rates September 18th. So that is a certainty. I don't think even a 300,000 payroll number would really throw that into question. It would definitely throw into question November and December, but would that cause markets to fall if we avoid a recession, if we have a soft landing? Probably not. The risk is that jobs report comes in low. We're expecting 164,000 jobs. My definition of low would be anything under like 140. Really, anything under like 100,000 jobs, net job ads would be really bad news. And the unemployment rate is actually expected to fall from 4.3% down to 4.2%. If the unemployment rate were to instead rise to, let's say, 4.5%, you're going to rapidly price in recession risk into our markets. And that's why I think Friday you could actually see a circuit breaker get triggered. You could see the S&P fall 7% if the unemployment rate takes another big move higher when nobody's really expecting that it will. I do also see some very troubling signs as well today concerning the economic activity and the growth concern. The big one is oil. Oil is down 4.5% today, which oil is influenced by geopolitical tensions, by OPEC, by different heads of state, if you will, heads of government in the United States. But the biggest thing that affects oil prices is expected demand, and that comes from the economy. Think about UPS and FedEx and all the jets that are flying commerce back and forth each and every single day. Think about all the vehicles that are transporting commerce each and every single day, semi-trucks. Think about the true uses of the most oil and gasoline in this country and the world. It's not you driving your car. It's trade and commerce, things of that nature that revolve around the economy. So oil is actually a pretty good barometer of economic activity, especially when you see, oil fall 4.5%, almost 5% in a single day. That makes me scratch my head and say, is Wall Street, our investors, starting to expect weaker economic activity? Is that why oil is down 5% today? And I think this is a big red flag for any of you guys in the markets that are trying to figure out whether or not we're going to have a soft landing or hard landing. Oil today is screaming there could be some growth concerns out there. Today we did have the ISM manufacturing PMIs that came in at 47.2. We were expecting 47.5. That was an improvement from last month's number of 46.8, but missed the estimates. ISM manufacturing employment came in at 46.0. We were expecting 43.6. That was the standout of this report, was employment actually got better. Construction spending month over month fell negative 0.3%. Last month you were at 0%, and the estimate was only a fall of negative 0.2%. So that came in worse than expected. Manufacturing new orders came in at 44.6. We were expecting 47.7. So that's weighing a lot on markets today. Is why are new orders like collapsing? This is not a good number for manufacturing new orders. And then manufacturing prices came in higher than expected at 54.0. We were expecting 52.8. So the only thing positive in positive territory for ISM manufacturing is ISM manufacturing prices. So not only did you get, bad ISM manufacturing on the activity side, the actual manufacturing side, but you also got bad data from the prices or the inflationary side of manufacturing. So that is definitely weighing on markets today. The big catalyst tomorrow morning will be JOLTS job openings. We're not expecting much of a movement here. So last month you were at 8.18 million. We're expecting 8.1 million. So really only expecting about 80,000 job openings to decline, or a job opening decline of 80,000 in the month of July. The problem will be if this comes in at like 7.5 million or 7.2 or 3 million, because it's basically a barometer of economic activity if you really think about it. Because if companies are doing well, they're going to look to hire more people. If they're not going to hire as many people. So if companies are not doing well and they're not looking to hire as many people, yes, that's a bad sign for the labor market, but that's also a bad sign for economic activity. Okay, so the JOLTS job openings will be important tomorrow, and the lower the number, the worse the market reaction. You would think, job openings falling, labor market getting tighter would be good. No, that was good in years prior. That's not good at this point. So you actually want to see JOLTS job openings come in around the, expectation, or at least at the bare minimum, just meet expectations. That would be your best case scenario. And that is, I expect, going to cause quite a big move. Thursday, you do have the ADP employment change, initial jobless claims, ISM services, and same thing with services. You're really expecting a slight contraction across the board for all of the different components of the service report. So we'll see if that happens. And then Friday, again, is really your big catalyst of this entire month. That's going to solidify, to investors from their perspective, is the Fed cutting into a recessionary economy, or is the Fed cutting at just the right time to avoid a recession? And that data is going to tell us just that. Now, as I said in videos prior, I was actually expecting a bad Tuesday, Wednesday, Thursday, collectively, right? You could have a positive day in there, but overall, I was expecting some risk-off behavior heading into this Friday's jobs report because markets were at all-time highs. September is seasonally the worst month for stocks over the past 10 years with an average return of almost negative 3%. There's not a lot of reasons to be super excited about markets heading into such an important catalyst like the jobs report on Friday. So I expected some selling, but not the S&P down almost 2% and the NASDAQ down almost 3% and the Russell 2000 down over 3%. This is a lot of selling quickly. I did talk about this trade that is interesting. It's a $9 million trade betting that the VIX goes between $22 and $30 by the end of September. They paid $9 million with a max potential payout of $280 million if the VIX closes above 30 in September. This is really expecting the markets to get worse from here. You can see today their trade is doing pretty well with the VIX that is soaring. Last I looked, it was 18%. Now it's up 26.5% today. The VIX at $19.66. So you still need to see more of a decline from here to get the VIX into a 22 to 30 range. And let's be honest, if we hit 30, yeah, I think markets are going to be in full-blown correction territory at that point. Another interesting aspect of today is the RSP, the equal weight S&P, is only down 1%. So there's not that much pain out there in other areas of the markets. Like today could be a lot worse. A lot of the pain is concentrated in big tech. Nvidia's down 9% today. That is insane. Okay, now there's a lot of fears about Nvidia's employees. There was a new note put out today that basically says from Bill, what's his name? Bill Blaine, that there's not a lot of reasons for Nvidia employees to hold on to their net worth, being piled into Nvidia stock when a lot of the upside has already been essentially captured. He did refer to a recent poll that found that 40% of those who worked at Nvidia had a net worth between 1 million and 20 million. So almost half of your employees are rich, while 37% had a net worth of over $20 million. So a little bit over a third of employees are very wealthy or very well off that work at Nvidia. What's the incentive to work harder? What's the incentive to not sell your Nvidia stock and to realize and protect your financial future? That's basically what this veteran analyst or investor, if you will, said today about Nvidia. And that did spark a little bit more fears following Nvidia's earnings that came out last week that already had a bit of a negative reaction associated with it anyways. Now, keep in mind, this analyst, he's got his own opinions. It says, quote, "I just found my best reason to sell Nvidia, confirming we're at the top of the market. What might come next? How about 20 years of rising inflation, rising rates, and a global commodities supercycle as nations scramble to secure future strategic resources," he added. I mean, is that what I'm expecting? Obviously not. So you got to take things with a grain of salt always, but this is definitely having some effect on Nvidia today. And I mean, the stock's down 9%, so it's definitely dragging markets down with it. Other big tech stocks are down a lot as well. Google's down 3.5%, Apple's down almost 3%, Amazon's down 1%, Microsoft's down 1.5%, and Meta's down about 1.5% as well. It's really the companies that benefited the most from AI, the most from Nvidia as a sympathy kind of trade, that are selling off the most today. Google, Apple, Nvidia, they've all done well alongside Nvidia recently. And semiconductors overall are just doing terrible today. Again, this makes sense heading into such an important catalyst coming Friday. And I think there could be some more selling heading into that catalyst. If you look at the S&P, you're not in a good place. If this level holds into the close, yeah, that's rough, because we kept finding support around $555. And if we break under that and close under that, which it looks like we're going to, then you're set up for a test of that 50-day moving average around 548.37. Okay. And if you don't hold there, that's where you could potentially start to fall much lower, down to 534 would be the next level, that 100-day moving average. And then you're just getting into a really bad place if you're under there. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. You guys have a great rest of your day, and I will see you in the next one.